I am AI Avatar of CA Ratan Mundra. In this video, we will explore the framework that governs ship leasing operations within GIFT IFSC. The purpose of this framework is to facilitate structured ship financing, ensure compliance with regulatory requirements, and promote transparency for investors and stakeholders. It covers the scope of activities that a ship leasing entity can undertake, including leasing, financing, and asset management support. This framework is significant because it defines the legal and operational boundaries for SPVs, fund sponsors, and service providers. Understanding it helps businesses avoid regulatory pitfalls, align with global best practices, and create efficient maritime investment platforms. Today, we will also discuss the interpretation of group entities and the TAS regulations route for providing support services. By the end of this video, viewers will understand the critical elements required for regulatory compliance and operational efficiency under the IFSCA framework. The representation to IFSCA highlights a practical business scenario involving multiple special purpose vehicles or SPVs. Each SPV will operate under the ship leasing framework to acquire or lease vessels, while a centralized ship management entity will provide operational and commercial support to all SPVs. The key issue addressed is whether these SPVs and the ship management entity can be considered as group entities solely based on sharing a common brand, even without direct equity ownership. This question is important for determining the eligibility of the ship management entity to provide asset management support services. Investors, regulatory authorities, and internal management rely on this clarification to ensure that operational models are compliant and efficient. By framing this issue, the representation provides IFSCA with a clear understanding of the structure and seeks guidance on permissible service activities. Let us break down the proposed operational structure. Global investors commit capital to a central fund or sponsor, which then establishes multiple SPVs in the GIFT IFSC. Each SPV owns or leases specific vessels to execute the investment strategy. A dedicated ship management entity is proposed to provide technical and commercial support to all SPVs centrally. This setup allows efficient coordination for chartering, voyage estimation, compliance, maintenance, and reporting. Centralized support ensures expertise is shared, operational consistency is maintained, and investor confidence is strengthened. However, the regulatory question arises. Can the ship manager provide these services if it is not directly an equity holder of the SPVs? This distinction will determine the licensing route and permissible activities under IFSCA regulations. Regulatory clarity is crucial because the ship management entity's role involves more than routine administrative tasks. It handles critical operational, technical, and compliance functions. These include negotiation of charter parties, voyage estimation, technical supervision, dry docking coordination, fuel testing, and emissions reporting. If these services are not permitted under the ship leasing framework, the entity risks operating outside its license, which can jeopardize investor confidence and trigger compliance penalties. Clear guidance from IFSCA ensures that business structures are legally sound, supports operational continuity, and aligns investor expectations with regulatory requirements. Essentially, regulatory clarity protects the business model, investors' interests, and ensures sustainable operation of the platform. The first significant regulatory clause addresses permitted activities. Earlier, asset management support services could be provided only for assets owned by the entity or its wholly owned subsidiaries. The revised framework expands this to include assets owned or leased by group entities set up in IFSC. This change shifts the focus from ownership to relationship-based qualification, introducing flexibility but also interpretation risk. Entities must assess whether the SPVs and the ship manager qualify as group entities. Documentation such as brand usage agreements, service contracts, and board approvals becomes essential to support the relationship. The practical implication is that businesses can centralize operations across multiple SPVs, improving efficiency and reducing duplication, provided regulatory conditions are met. The definition of group entities includes parent subsidiary, joint venture, associate, related party, common brand name, and equity investments above 20%. The representation raises the issue of whether these conditions are cumulative or alternative. Essentially, can a common brand alone suffice, or is equity participation required as well? This distinction affects whether the ship management entity is authorized to provide support services to SPVs. Comparable frameworks such as GRCTC and Global In-House Centers often treat these relationship tests as independent. A correct interpretation enables centralized service provision without requiring direct equity ownership, which supports operational efficiency and investor confidence. If the ship management entity does not qualify under the group entity test, the TAS regulations offer an alternative route. Under TAS, asset management support services are listed as permitted ancillary services. However, there are strict limitations. Physical operation, logistics, and construction services are excluded. Service agreements must be carefully drafted to define permissible support activities, such as commercial coordination, technical oversight, compliance reporting, and voyage estimation. Any activity resembling physical management of vessels may trigger compliance violations. Proper documentation and scope definition ensures regulatory alignment while still supporting the financial leasing activities of SPVs. Material changes from ownership-based to group entity-based tests significantly impact operations. Centralized ship management enables efficiency across multiple SPVs, but regulatory boundaries must be carefully mapped. Asset management support services must be distinguished from prohibited activities, such as physical vessel operation. Documentation should include group entity assessments, service agreements, operating procedures, and reporting templates. Properly managed, these changes reduce operational duplication, enhance governance, and ensure compliance with IFSCA requirements. A well-documented framework also mitigates the risk of regulatory audits and protects investor confidence. Key risks include assuming that common brand name is automatically sufficient, misclassifying service scope, or starting operations without the proper license. If common brand name is not accepted, the ship manager may not qualify under the ship leasing framework. Broad service descriptions may be misinterpreted as physical asset management. Delays in obtaining regulatory clarity can affect timelines and investor confidence. Risk mitigation involves preparing thorough documentation, defining service scope precisely, obtaining board approvals, and seeking informal or formal clarification from IFSCA. Early action ensures operational readiness and compliance, minimizing potential regulatory or financial setbacks. To conclude, the immediate action plan involves preparing a detailed structure chart, documenting group entity relationships, and ensuring legal evidence for common brand usage. Service agreements should define permissible support activities and exclude physical asset management. Board and investor approvals must be obtained. Reporting and compliance systems should be established before operations begin. The ultimate goal is to ensure the ship manager operates within the regulatory framework, supports SPVs efficiently, and maintains investor confidence. By following this plan, organizations can successfully leverage the ship leasing framework while staying compliant and operationally effective. Regulatory clarity, strong documentation, and proactive engagement are the keys to successful implementation. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT IFSC and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA. Comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.